Hello everyone, this is Ahmed Al-Azaiz speaking to you and welcome to another training video with Forex Trading Signal. Today guys, we're gonna go to continue with the economy indicators and we're gonna go to speak about the Producer Price Index, the PPI. So stay with us please, we will start in a moment. So first of all, guys, what does the PLS mean? And what does the Producer Price Index mean, the PPI? So to understand this, first let's go to the PLS. The PLS is the Bureau of Labor Statistics in US. That is an office located in US, and that office is collecting the data and the research around the consumer price index indicator and the producer price index indicator. So we will understand these in more detail in a bit. So let's talk about the producer price index, and previously we have spoken about the consumer price index, the CPI. And if you did not watch that video, please go ahead and watch it so you can understand what is the consumer price index, and then come back to this video and watch it to understand what is the producer price index. So the type of the producer price indexes are two types, and those two types are the highly impact type, first type, and that is the producer price index PPI highly impacted one. So why it is highly impacted and why we say it's the first type? Because it's measuring all the finished goods and services, including the energy and the food. So it's measuring all the goods and services produced by the companies and the factories, including the energy and the food products. So this indicator actually is measuring all the services and goods sold and produced by a producer, and it's based on the demand. That's why it's relating directly to the inflation. The second type of the indicator, the same indicator, it's the core PPI. So we said that the PPI is the producer price index, and the core PPI, it's again the producer price index. However, the core PPI, it's excluding the energy the prices and the food prices. So the difference between the core and the normal PPI, that the core PPI is excluding the energy and the food. The highly impact PPI is including the finished goods and services and including the energy and the food prices. So now, what makes the core PPI less important than the normal or the high impact PPI? Because the food and the energy, it makes up 40% of the indicator. So when you calculate the food and the energy, those two products are making up about 40% of the indicator. So that is what makes the high impact PPI is more important than the core PPI, because those two products, the food and the energy, making up 40% of the indicator. However, this doesn't mean that this indicator is not good, and those are the two types of the indicator. So let's understand now what does the producer price index mean in details, and let's go to the website. So guys, this is the producer price index, and let's go initially to the historical data of this office. So you can see that the Bureau of Labor Statistics is an office located in US, and it is part of the US Department of Labor now. And you can see that this office was established in 1884, then was transferred to Department of Interior, then finally it became part of the Department of Labor in US. So coming back to the indicator, this indicator is now produced or prepared by the United States Department of Labor and by this office, the Bureau of Labor Statistics. So when it comes to the indicator, we said that this indicator is mainly depends on the demand of the consumers for the final goods and the final services. So those are the indicator data, and you can see here food, energy, and services and goods measurement, and you can see here the change on monthly basis and the change on yearly basis for the price based on the demand. So to explain that properly, I would like to come back to the PowerPoint slides. And if we ask ourselves, what is the price producer index mean and how it does look like? So if I say that I have factory here and I have companies producing services as well. So the factories will produce goods and those goods will be sold out for consumers and it will be imported or consumed by international countries as well. The services also will go to the consumers. So now I have the products, the goods, and I have the services, and both of them going to the consumer. So now if this consumer demands more services and more goods, so those factories and companies here, they will increase their prices based on the demands of the consumer. So also previously we have made a video for the demand and money supply, and I advise you to watch that video to understand how does the demand and the money supply works. So if you did not watch that video, please watch it again. So we said that the factories and the companies will raise their prices based on the demands of the consumers. And that is how the indicator is being changing from level to another level, or the percentage. So now let's go to the Forex factory and understand how this indicator is being scaled or how this indicator is being calculated. So let's go together to the Forex factory website. So in the Forex factory website, you can see this is the PPI indicator, the high impact one, and this is the core PPI, the low impact one, and this is, we said, it's excluding the energy and the food, or the food and the energy, and this is including the prices of the food and the energy. So let's go to the first one, and you can see the historical data here, and you can see that the more this indicator is going up, positive result, the more is good for the currency, that means for the USD. And if the USD raised up, that means the gold price will go down. However, if we want to understand the scale of this indicator, if I come here to this area, we understood before from the previous video, this is the forecast and this is the actual reading here. So the indicator is scaled from 0. If it's above 0, it doesn't matter. If it's below 0, it doesn't matter. The matter here that is the change on monthly basis or on yearly basis. So if I can see here, the indicator was previously 4, and that was in month of October. And month of November, we have forecasted also for 4. However, the data, actual data was coming below 4. So you can see that the indicator has gone down 2%. So this is the indicator and how it looks like. And we say that we're going to go to look into the change. We don't want to look into the indicator, whether it's negative or positive. Now, let's go back to our slide. So now, what happened if the indicator come positive? So we said that this indicator is based on the demand, and the demand is based on the consumption of the consumer. So if the demand more, that means the consumers are demanding more. That means their consumption is more. That means those services and factories, companies, they will increase the prices, and this will lead to inflation. So if the services and good demands start to raise up, that will increase the prices, and that will lead to high inflation in the market, and that will lead the central bank to increase more the interest rate. Hence, the US value will go up more and the gold value will go down. So this is how the indicator works, and this we call it leading indicator because it tells us in the future what is going to happen in the inflation. So finally, guys, if you like this training video, please subscribe to our channel and click the like button and share this video with your friend, and see you in next training video.